Hello, my name is Jenny, and I'm the founder and CEO of Gift Planning Services. I want to welcome you to our webinar, Special Needs Trusts, Protecting Vulnerable Heirs. We are excited to explore all that these powerful tools have to offer, explain some of the confusing parts, and provide you with a foundational understanding on how they can benefit your loved ones or families that you know. Before we get started, just know that we'll have a question and answer session at the end. As we go along, feel free to submit questions in the chat box or the Q&A section. I will take note of all the questions so that we can circle back at the end. Now let's get started. I am joined today by Christy Boyson. If I built the GPS ship, Christy steers it. She brings oodles of business sense, leadership, and a winsome personality to the team. Christy has a background in psychology, communication, and higher education. When these three worlds come together, she shepherds families through the process of creating a meaningful legacy plan. She's also the only GPS team member who's biked all the way across the country. Our other host today is Ryan Johnson. Ryan came to Gift Planning Services last year from the marketing and advertising world. He hit the ground running and loves connecting with nonprofit organizations and helping families maximize their impact on their heirs and the charities they love. He's the GPS team member most likely to be found on a golf course, and he's definitely the one you want on your trivia team. That's today's cast of characters. So let's dig in.
Awesome. Thanks, Jenny. At GPS, we serve in many different ways, and each of those weave charitable giving into our framework. Our goal is to provide education that allows families, individuals, and organizations make a greater impact than they thought was possible. We do this in a few ways, but each of these bring together the donor, charities they want to impact, their current professional advisors, such as financial advisors, CPAs, and attorneys, as well as community foundations that will help them accomplish their goals. Now, we're an objective third party, so we're not trying to sell anything or draft any legal documents. We just want to help show a holistic snapshot of how everything fits together. So we actually coordinate with your advisors to help you complete your plan. So that's a little bit about us. Now let's get into why we're here today. So in America, about 60% of all adults still don't have an up-to-date will, and this is including after a mad rush to get a lot of that done last year. But at the same time, 20% of families in the US have a member with special needs or a disability. So if you or someone you know is trying to come up with a plan, but also wants to account for special needs individuals, it's especially important to be proactive. Now, a common starting place with any estate plan, but especially someone with a special needs family member, is what happens if I don't do anything? And what's true for them is typically what's true for what would happen to anybody. Assets essentially just get passed on to heirs. First, the state looks down to any descendants, then it looks up to maybe if your parents are around before it looks out and tries to go from there. But under most plans in this situation, assets would go directly to heirs, which is potentially a problem, and we'll discuss later why that may be. And the last part is just assets typically don't go where people want them to. And that's typically why they call it estate planning. And it's just a reason to be proactive and to make sure that they go the way that you want to. But that kind of leads us into our subject for the day, which is special needs trusts. So for most people we work with, their goal in planning their finances and when drafting an estate plan is primarily to provide for those they care about. Commonly, this is achieved through different strategies, such as saving for college expenses, retirement, and when thinking through an estate plan, making sure that they can provide for others after they're gone. And for those who want to provide for someone with special needs, the provision can require a lot of detail and consideration. And so when other components come into play, like government programs and the funding they provide, it's really important to ensure that the plan doesn't negatively impact those involved. So this is where special needs trusts can come in. As with trusts we have discussed in the past, the format for special needs trusts also known as supplemental needs trust, is a fiduciary relationship that allows a third party or trustee to hold assets on behalf of a beneficiary. In this case, the beneficiary would be a physically or mentally disabled or chronically ill person. So instead of leaving assets directly to someone, you can leave it to a trust. For those in the special needs community, there are a number of government programs, primarily supplemental security income, that can cover costs for people with disabilities who have little to no income. So this is a powerful and helpful resource, but eligibility and maintaining your eligibility for those programs is very important. So special needs trusts are a popular strategy for those who want to help someone in need without taking the risk that that person will lose their eligibility for the programs, because often those programs have requirements as it relates to income or assets, and they have to stay below certain limits. Because the beneficiary would have no control over the money in the trust, government programs such as supplemental security income or Medicaid, administrators will ignore the trust property for the purposes of program eligibility. So to get into a little bit more detail just about the government funding components, that's kind of a huge thing you'll hear us reiterate today, is trying to maintain eligibility for some of those programs. So if you want to leave an inheritance to a loved one with a disability, whether that would be financial assets or even property, you need to plan carefully. Often the funding from benefits, such as supplemental security income or Medicaid, are based, again, on income or assets that are held. They might not count everything. So if you have a house or a car, furnishings, or other normal personal effects, that might not impact your eligibility, but it's important to clarify because it can change based on the state. But other assets, as simply as cash in the bank, will disqualify you. And for supplemental security income, as little as $2,000, I would say that you have more than what they deem is enough to not need that. And so, as you can imagine, that's not a lot of money to mess around with if you're really worried about getting funding from the government. And so using special needs trusts can be really, really advantageous. So Christy, you want to share a little bit more about how special needs trusts actually work?
Absolutely. So I'm going to walk through 5 different points here. The first is that funds from a special needs trust can cover the part of an individual's financial needs that are not covered by public assistance. SSI covers basic needs for food, clothing, and shelter, but there are often many more costs that it does not cover. And so these types of trusts can help provide additional support beyond that. Assets held in a special needs trust do not count for the purposes of qualifying for public assistance. Ryan's mentioned that, but that's just an important thing to highlight here as to why this is such a fruitful and helpful trust. The person who creates the trust gets to select a trustee who will have control over the trust. So they will determine how the funds are managed as well as how they get dispersed. They should be aware of the needs of the beneficiary so they can make timely distributions in the event that a qualifying need arises. And the trust cannot give money directly to the beneficiary, as that could interfere with program eligibility. But they can spend the assets on a wide range of necessary goods or services. Some of the most common distributions from this type of trust cover things such as out-of-pocket medical and dental expenses, physical rehabilitation, caretaker expenses, vehicle or transportation costs. I see that one used quite a lot. Education, recreation, and vacation. We all need that sometimes. And then other permitted expenses. And finally, the special needs trust ends when it's no longer needed. Commonly, that's at the beneficiary's death or when the trust funds have been spent. So let's talk a bit about different types of special needs trusts. So there are 3 main types that we'll walk through. The first is called the first party trust. The second is the third party trust. And the third is the pooled trust. And all 3 of these name the person with special needs as the beneficiary. So we'll start first with the first party special needs trust. And let me walk through how this one works. So the way it's designed is to hold assets that belong to the person with special needs, such as an inheritance or a settlement from a lawsuit, perhaps an accident of some sort that had a payout. Typically, a special needs person does not start with a significant set of assets. So this format allows them to adapt to unexpected windfalls. And it doesn't have to be a lot to fund one of these trusts. Even something like $10,000 can throw the eligibility off, like Ryan mentioned. And so this type of a trust really helps protect that individual with special needs, where they can set it up and then benefit from the fruits of it. By placing their assets into a special needs trust, they can still qualify for funding. It allows someone who's receiving benefits to continue receiving those benefits. And this way, they don't have to change their lifestyle or planning temporarily. While the beneficiary is living, the funds in the trust are used for their benefit. And when they pass away, any assets are used to reimburse the government for the cost of their care. This is called the payback provision. And if there's anything left over after that, then the excess would pay to a new beneficiary. It's still in their benefit to do this because they can get the most aid while they're living with this format, and it allows the assets that belong to them to not count against them. This trust, the first party special needs trust, is actually a relatively new option. It wasn't until 2016 that this came into effect. Prior to this, any individual would have to use up the new assets until they were eligible again, and then have to reapply, which could cause understandable confusion and stress on the part of the individual with special needs.
Yeah, Christine, just to hop in really quickly, I want to reiterate that point. I was talking with a gentleman who works in this area a few weeks ago, and he was mentioning how there was someone who did get a windfall from a lawsuit, but it was just $6,000. But that person understood that their own benefits were at risk. And so they came coming to the organization just like, how can I figure the situation out? Because just having that in the bank could limit their eligibility. And we'll talk about another story a little bit down the road. But it is just crazy to think about how some of those more modest sums of money can still throw stuff off.
Mm-hmm. Thanks, Ryan. That's a helpful little story. So let's talk about the third party special needs trust. So these are absolutely the most common type of special needs trusts. They hold assets that belong to other people that want to help the person with special needs. Typically, the grantor, the person who funds this, would be a parent or a family member that really wants to care for their loved one. These trusts can hold any kind of assets, including house, stocks, and bonds, or other assets or investments. And when they're utilized or implemented in estate planning, they can also be the beneficiary of insurance benefits and retirement plans as well. Again, the assets of the trust do not affect the beneficiary's access to benefits from government programs. The unique thing, or one of the distinguishing characteristics between the first party special needs trust and the third party special needs trust, is that the third party does not contain that payback provision. So this means that when the beneficiary passes away, any funds remaining in the trust can pass to other family members or to charity. We actually see a lot of families decide to utilize that charitable component as kind of an additional gift at the end of their child's life. And these types of trusts can be set up during the lifetime of the funder as well as through the will. So it's a bit more flexible in that capacity. So Ryan, do you want to talk about how the pooled special needs trust functions and actually works alongside these two that I've just talked through?
Yeah, absolutely. So
Thanks.
we say that there are three types, but in reality, it's kind of like two types and then two types with an asterisk. And so this third type is called pooled special needs trust. But essentially, these are special needs trusts that are actually hosted by nonprofit organizations. And so they pool and invest funds from many different individuals or families, but each trust beneficiary does have a separate account, and the trustee chosen by the nonprofit then still spends money on behalf of each beneficiary. So pooled trusts are sometimes referred to as community trusts. They're available in many parts of the country, including here in Minnesota. And there's a couple of reasons why someone would want to choose a pooled special needs trust as opposed to just having their own independent trust. And that would be if you can't come up with a good candidate to serve as a trustee, or you can think of one, but they're just not in a position where they'd want to do that for understandable reasons. That would be one reason. And another would be if you feel like you're not actually able to leave a substantial amount for your beneficiary. There are costs that are, included when it comes to setting up special needs trusts. So it might be wise to consider a pooled trust option through a nonprofit if it's a more modest sum. That being said, again, with these, it can be first party or third party. And so if you're an individual and you're trying to maintain eligibility. But again, it's just a modest sum, and you don't want to spend a few $1,000s to set up your own trust when you've really only had a few $1,000s that could throw off your eligibility. This can be a great option. Tons of flexibility because of the smaller account sizes and fees that are associated with them. And a lot of organizations that run these are really, really helpful and very educated and up to date, so they can make sure that what you are looking to do is the best case for your specific situation. So just in review, the format for all of these different trust options are pretty straightforward. First party, it's for them, it comes back. Third party is initially from someone else. But thanks to solutions like the nonprofit pooled trusts, there are truly options that can fit any situation, which is really nice. But before we move on, I did want to just re-emphasize the importance of proceeding carefully. You want to be careful about these differences because the reality is they're not actually commonly understood, even by employees of the government who are in charge of enforcing a lot of these, which may or may not be a surprise to some of you. But I just want to share an example from a lawyer recently that explains the sensitive nature of some of these special needs trusts. So this lawyer represented a man with a psychiatric disability. That man's mother had passed away, and her will left him her house in trust. The will said that the trust should cover his special needs only, and it even actually said in the will, if he lost his benefits because of this, the house should go to charity instead. But the man simply told Social Security that he had a special needs trust, gave them a copy of the will, and he promptly lost all of his benefits. But it was a terrible mistake, and actually it took a couple of years and a judge and attorney costs just to get his benefits back. But what they found out was he had simply described the trust in a way that they did not interpret correctly. So they actually thought he meant a first party trust, so one that he had the assets to begin with. And if it's a first party trust, as we know, it has to include the payback provision. But they did not see the payback provision and thought that it disqualified him from eligibility. But in reality, it was a third party, like we know. So the first party, the payback provision was not required. The problem is if you call us a third party supplemental needs trust, a special needs trust, and it doesn't have the payback provision, they might say that it doesn't qualify because it doesn't meet the requirements. Then they can count it as a resource. The beneficiary could lose the benefits, or at a minimum, there could be problems for a long time. And that's what happened to this lawyer's client. So that would be a mistake because there actually is not a payback required unless the trust assets belong to the beneficiary in the first place. But we'll mention this a few times, but I can't help but reiterate, speaking with an attorney who specializes this, especially in the state that you're looking at setting it up, because the rules do change state to state, and the rules also change pretty often. And so you just want to make sure that you're really, really clear. And unfortunately, sometimes misunderstandings can cause really big problems for years. And that can really throw off things for individuals who really count on that funding from programs. So if we look at just the benefits of special needs trusts in general, just to reiterate again, there's an opportunity for beneficiaries to receive financial support without putting their eligibility for them programs at risk. But another cool component of special needs trusts is that they cannot be accessed by creditors or lawsuit winners against the beneficiary. For the same reason that those assets are not counted against them for eligibility, they can't be accessed from those creditors and lawsuit winners because they're not the beneficiary's assets. They're actually owned by the trust. They're simply used to cover costs for the beneficiary. And so that could have been an issue if it was a traditional trust and not a special needs trust, where anytime they got a payment from the trust, for example, they would then have assets that could have access. But since the trust does not pay to the beneficiary, it just covers costs for the beneficiary, you're kind of free from that. One other kind of really cool component to think about is just the idea of gifts. And so if you set up a special needs trust during life for someone, it can actually act as like a receptacle for gifts from beneficiaries' friends or family, without, again, impacting their benefits. And it can be really nice during holidays or birthdays, for example, where you really want to give a gift to someone you care about, but you're aware of their situation and you don't want to ruin some of their eligibility. And so one more thing I would just highlight in the situation, if you are a family with special needs trust or an individual, it's really important to make sure you educate your friends and family about some of those components. You'd hate to get written a very generous birthday check for $500, for example, that puts you over the asset limit and then ruins the rest of your year just because someone was trying to be generous. And so it can be a really cool way to make sure you're being intentional with your generosity as well. So obviously benefits exist for the beneficiary, of course, but it can also be helpful for the person who sets up the trust in the first place. The person who set up the trust can have the peace of mind that the proceeds will go to the expenses they outline. For example, parents might put assets into a special needs trust to provide for their disabled daughter instead of just giving it all to their son with the direction of him to care for his sister. It's just a great way to continue to provide for those even after you're gone. They can aid in the preservation of family wealth. This reason is very similar to people using any other type of trust. They create a way to provide assets while limiting their use, and this also can help ensure that wealth is allocated properly. And then lastly, the trustee role is really beneficial and can aid in that peace of mind. Knowing that there is a party who's responsible for looking out for a loved one, even after you're not around anymore, can really be a crucial part of the planning process. I'm actually going to give back to Christy to share a little bit more about that trustee role.
Definitely. So it's often really important to consider who should serve as a trustee, really for any type of trust, but specifically when it comes to a special needs trust, who is the right fit? Is it or should it be a family member or a good friend, or is a corporate trustee better? And so there are a couple of things to consider in this process of making the decision. So oftentimes we hear from families that we want to name a family member as the trustee to keep things simple, less costly, and what we have seen is that that is not always the case. So a couple things to think through would be the relationship between the potential trustee and the beneficiary. It might cause a strain if someone is responsible for saying no at times when it comes to expenses on that relationship. And so again, thinking through a good fit, are they comfortable with saying no? And what would that do to that relationship? And the protecting and conserving that can be important. Another piece is, does this potential trustee understand, or are they willing to learn the complexities of government benefits? So the trustee in this role is going to need to learn about and ensure compliance with rules and how the trust distributions might affect the beneficiary's benefits, and keep up to date on all of that in the event that it changes. It is not a small task to stay on top of that. Another component is taxes. So oftentimes family members will need to rely on tax professionals for assistance in completing this service. And again, not bad to consult, but it's just another piece of the puzzle to consider. And then one other big one is just the potential liability of serving as a trustee over a special needs trust. If the trustee makes an improper distribution or fails to file the required accounting documents, there could be issues. And family members typically do not carry appropriate insurance to cover liability for these types of circumstances. So what do you do? If you really want a loved one to serve in this role of trustee, but you're also not wanting to burden them with some of these extra roles and responsibilities, there is the ability to have the family member serve as co-trustee with a local corporate trustee. When there is clarity around different roles, it can be a really, really good option. Professional trustees can handle the taxes, the investments, and accounting, and they can advise family members on distributions. But ultimately, that family member trustee or co-trustee can still have a say in the matter. So the family member in this case would be listed as allowed to distribute. And so just some things to think about when it comes to selecting a trustee, and it certainly applies here, especially, but if you're also thinking through your own personal plan, whether or not a special needs trust is a part of that, these are things to consider in that space as well. So let's talk about just some things to consider around special needs trust. So there are some other nuances we want to make sure we highlight. So you might want to consider establishing a third-party special needs trust during your lifetime, or change or update your estate plan to establish this type of a trust upon death. Depending on your current financial situation and, of course, the circumstances surrounding the beneficiary, both of these can be really good options. We highly, highly recommend that you have legal counsel draft the terms of the trust. While it's technically not always required when drafting this, having counsel helps ensure that it's valid and that the terms you've outlined are really clear. The allowable expenses, for example, should not be open to interpretation. So again, having the guidance of someone who does this all the time can be really fruitful. You will also need a lawyer if you want to create a trust that will be funded with the beneficiary's own money, so the first party trust. A reason for doing this might be a settlement from a personal injury lawsuit or something like that. This type of a trust would definitely require the drafting of documents. Why is that? Because complicated and state-specific rules can apply in these situations. So being really, really clear and utilizing their expertise will be helpful. Another piece is that special needs trusts need to be established before the beneficiary turns 65 in most states. So if you are considering a trust of this variety for an aging beneficiary, it is best to consider moving forward sooner rather than later. Here in Minnesota, we used to have the 65-year-old age limit, but recently the Minnesota Supreme Court decided to allow for beneficiaries over the age of 65. So here we're seeing that lifted, but that's not the case everywhere. Another reason that you would want to establish something before someone turns 65 is that despite the planning being more complicated, a special needs trust can also be used to provide for elderly adults in need of Medicaid paid long-term care in states that allow it. So just a couple things to proactively consider when we're looking at aging individuals and how this type of trust might support them. And then the final piece that we'll highlight here is that another option that might fit during current life planning is called an ABLE account. So how this functions is the distributions from these accounts are tax-free so long as they cover qualified expenses and as long as the balance is under $100,000. If that's the case, they're not counted in asset calculations for public funding programs. These are great options for individuals who are still able to make sound financial decisions. If that's not the case, a pooled special needs trust is definitely a really good option. These types of accounts are structured similarly to the college 529 plans, if you're familiar, but the qualifying expenses are more broad because they're going to support the special needs beneficiary and not just education. So that's a helpful way to think about how these function. Something to note is there are specific eligibility requirements for these, so definitely consider speaking with a lawyer before opening one up. Ryan, do you want to talk through how charitable giving fits into these types of trusts?
Absolutely. Thanks, Christy. So often the donors we work with, they want to make sure they can provide for their heirs, but they're also interested in remembering charity as part of the plan. When they get the whole process started, they feel like they're not able to do both, or anything that they're going to give to charity would actually just mean giving less to their kids or their heirs. But this doesn't actually have to be the case. Oftentimes as well, especially in the area of special needs, there are so many wonderful nonprofit organizations that do really, really meaningful and helpful work to support and help those with special needs. And oftentimes family members see that, do give to it to that organization, but also want to remember those charities as a part of their estate plan so that other families can be benefited and blessed by that work as well. But when you are drafting an estate plan and planning for those with special needs, it's important to consider the types of assets that the trust would be inheriting. So this is true of any approach to estate planning. It's really, really helpful to take a look at the assets and the tax characteristics because that could determine the strategy you have. But this is also especially important because special needs trusts are actually taxable trusts. So the assets that are transferred to the trust maintain the same tax characteristics as if an individual received them. So essentially that means the assets would be treated again as if a child inherited that asset. So especially when you consider pre-tax assets, such as retirement accounts, which are a common form of inheritance, any traditional 401ks or IRAs would be taxed as income when the trust received it, which can be a very interesting component. So we're going to go through an example here of a couple that had one disabled daughter that they wanted to plan for. And so when they were thinking through what they wanted to do, they knew about special needs trust. They were very proactive in that sense. And they also just, their thoughts were, I love you, daughter. I just want it all to go to you. So they had a more modest estate when doing the planning, but $260,000 of their $600,000 estate was in pre-tax assets. So the rest of it, the balance, just went to the special needs trust. But the pre-tax assets also went to the special needs trust, but they had to be taxed. And if you are familiar with special needs trusts, the tax brackets on them, typically people say that they're immediately the highest tax bracket, but what's actually true about them is they just scale a lot more quickly, similar to our individual tax brackets where different income rates produce different percentages. Once you reach $13,000 of income with the special needs trust, you're automatically at the highest tax bracket. So transferring that much pre-tax assets creates a lot of income for a trust. And as you can imagine, there would be a substantial state and federal tax component to that. And so, sure, at least she's still getting a substantial amount of the estate. But in this plan, the couple was, still wanting to make an impact to some of those organizations that they were talking about that were beneficial and helpful and supportive to their child. So when we work with them, we thought, what if there's another way that could both provide for their daughter and the special needs trust after they're gone, but still incorporate charity in a way that would be really helpful. And so this is where we included both a bequest and a charitable remainder unit trust. And so this strategy worked again because they had some significant pre-tax assets. And so right off the bat, they were able to make a 10% bequest to those organizations that they're really passionate about to help them continue their mission in supporting individuals like their daughter. She still had a substantial, gift in the trust that was going to cover expenses for years to come. But now they were also able to set up a charitable remainder unit trust. And how this specific charitable trust works is it's actually not a taxable trust because it is a charitable entity. The way that they set it up was the charitable remainder trust pays out a specific percentage for a specific amount of time. If it's set up during life, it can be for life plus a term of years, or testamentary, it would be a term of years. And so they elected to do a 5% payout for 20 years. And so this kind of projection assumes that the trust assets which are reinvested are going to return at least 6%, which is a pretty safe bet over the course of that time. Some years it may be less, but some years it may be more. But what's really great is that first year payout of $10,000, as I mentioned earlier, is not in that highest tax bracket. And so the tax implications, even on that pre-tax retirement assets going to a special needs trust, are significantly less. And so the estate is paying a lot less taxes, the trust is paying a lot less taxes, I should say. And there's actually more money in the situation being transferred to the daughter over time. And so for that reason alone, that makes a lot of sense. It's a great way to spread out the payments of those retirement accounts. But now there's this huge component that makes a charitable impact, and that's called the remainder interest. And so the way that a charitable remainder unit trust works is whatever's left at the end of the specified time, so in this case 20 years, whatever's left in that trust then gets distributed to charity. And so that's why it's called a remainder unit trust. Whatever the remainder is goes to charity. As you can imagine, the growth of that over time, so if it's growing 6% and paying out 5%, it's actually growing a little bit every year. And that assumes, again, the regular growth. Oftentimes it might even be more than that. Now there's a huge charitable gift at the end. And so if we take a look at the breakdown, you can see that the assets transferred is actually substantially more to the child, which was great for this couple. But now they were overjoyed about the impact potential that they, before their plan, just because they wanted to say, hey, let's give it all to the daughter, there was no opportunity for them to include some of those charitable organizations that they love so much. But now nearly half of their initial starting estate is able to make an impact. And so they moved significantly more money by utilizing some of those vehicles, and were able to provide for their daughter. And so the potential when you're able to think intentionally is profound. And again, this is just one specific, pretty straightforward situation for one family. If there are multiple children in that example, the payments could be going to multiple people, or apply it in a different way. And in essence, when you incorporate a special needs trust into a part of your plan, it can be really straightforward and beneficial to that person if you're able to be intentional. And so it's really exciting to think about some of the potential, again, with intentionality. But again, that's just one situation. And so I'm going to go ahead and send it back to Christy to wrap it up.
Thanks, Ryan. I always get excited when we get a chance to talk about ways that families can give more to their kids and also make a huge gift to charity. That's the business we're in. That's the passion that we have. So thanks, Ryan, for walking through that.
Yeah.
So one piece that we'll just highlight, and we hope this has come across throughout this presentation, is that every person with special needs is different, which means that every special needs trust is going to be different as well. So if you're in the position where you are considering one of these for the support of someone important to you, or you know someone who is, please reach out. We'd love to help you think through what the best fit is, how to create an intentional plan, because we're passionate about teaching and helping families think about options. We also are passionate about just educating in general. And so a couple tangible next steps for you would be, reach out to us. We would love to talk with you, whether it's for your own family, your own situation, for someone that you know. Maybe you work in an organization that serves a lot of families like the ones we've described that might need this. Again, reach out. We're a resource. And then we do have a couple upcoming webinars. So if this was helpful for you, the next couple are focused on a few different topics. So on August 5th, we will have a webinar on sowing good. We will be discussing gifting crops and how that can be beneficial for, of course, the organization that receives them, but also the significant tax benefits of gifting crops and livestock for the individual doing so. On November 4th, we will be doing our kind of standard year-end giving webinar. We'll talk through an overview of the most tax efficient ways to give at the end of the year, go over some strategies that you may not be familiar with. And because we're still kind of coming out of the COVID world, there are some different pieces that are a part of the CARES Act and such that we'll also touch on so that you're maximizing what is in front of you on that front as well. You won't want to miss these. Again, our goal and our heart is to educate and help families think through what their legacy can be. So I am going to open it up for some questions. Jenny, take it away.
Thank you both for a great presentation. It's amazing how one special needs trust is not like the other, and the need for good counsel with it as well. Just want to reiterate what Christy had said. We are an educational resource. We will not draft those trusts for you, but we will help educate you so that when you go to your attorney, you understand what they are working on your behalf. We have several questions. The first one: after the beneficiary dies with a pooled special needs trust, does the charity receive the proceeds?
So answer to that question is yes, sort of. With the organization that I've spoken with, they would get 10% of the remaining balance. And if it was the first party, again, there is a payback provision, even though it is a pooled special needs trust. But there is kind of an extra, the government recognizes the service that the nonprofit is providing in that, and they allow them to take some of that. I'm fairly certain with the third party special needs trust, pooled, that it would be the similar, where there'd be a 10% to the charity, and then the rest would go to the remaining beneficiaries. But I would want to make sure I confirm that. And so I know that there was a 10% remainder going to the charity that was hosting for those organizations, but I'll get Jenny to give me your contact information just so I can confirm and follow up with you later this week with the correct answer to that.
And I'll
Excellent.
just jump on that too. So for any type of special needs trust, you would need to name a secondary beneficiary. So once that primary beneficiary has passed away, whether it's the first party that has the payback provision or the third party, you would still need to name who would receive the benefits at the end. And so if a family member is named, well, then a charity may not receive much beyond maybe the 10% piece for the host organization for the pool trust. But all of it, in theory, could go to charity if a charity is named or multiple charities are named. And we do see a fair amount of that. So couple answers there, but yeah, we'll definitely follow up with you.
And to piggyback off of what you said, Christy, another thing they mentioned was that's pretty common. And so oftentimes, if the beneficiary does outlive the trust, people who set it up through the nonprofit organization still want to benefit other nonprofit organizations as well. And so they mentioned, that majority of the time they're naming charitable entities as the secondary beneficiaries.
Our next question is, what should be funded first, the special needs trust or an ABLE account?
Great question. I would say that it really depends on your situation. If the beneficiary has a disability that does not affect their ability to make sound decisions, it may be in their best interest to do an ABLE account first. Again, that would depend on where they're at in life and what the nature of their disability is. But ultimately, I think that could be a good option, but also would want to recommend that you speak with legal counsel before ultimately making the call.
That same person had a follow-up comment, and they said that they have both, and they have been adding excess SSI to the ABLE account.
Nice.
So it's a great way to utilize it.
Yeah,
absolutely. The next question, sorry, Christy, did you have something you wanted to add?
Go ahead.
The next question, can an RMD, your required minimum distribution, the eligible grandparents, can they contribute to the special needs trust directly from an IRA? And if they do the special needs trust contributions qualify as charitable contributions, therefore reducing the taxable income?
I do not know the answer to this, but I'm going to, knowing what I know of the qualified charitable contributions and how a special needs trust functions. So for an IRA to pay out to a charity, it needs to go to a charitable entity. And a special needs trust is not a charitable entity, even if it has that clause at the end. The secondary beneficiary is charity, the primary beneficiary is an individual. And so my gut, based on understanding how both of these function, is that no, that would not work. Ryan, Jenny, any other thoughts or additions on that?
I would agree with that. And just as an added, the RMDs, you're not able to contribute the RMD or a QCD, qualified charitable distribution, to a charitable trust. It needs to go directly to a charity. So even if it were a charitable trust, it would not qualify.
Thanks,
It would be a generous gift, but again, it would be as if you received that money and then gave it to the trust. So it would be taxed.
Yeah.
And our last question is, how does a special needs trust function differently from other trusts? Then the follow-up question to that is, can't any family trust care for a child with special needs?
Yeah, so good question. And it really just comes down to where the trust is paying, right? So if a child with special needs is not relying on government funding, you might not need a special needs trust. But where a special needs trust really comes in and differentiates itself from any other trust is that traditionally trusts actually make distributions to individuals. So if you're a beneficiary of a trust, you will just get payments. But as we mentioned earlier, if you're an individual with special needs relying on government funding, if you were just to receive a payment, that could cause a ton of issues. And whereas the special needs trust, the trust doesn't pay the beneficiary, it covers costs for the beneficiary. And so that's kind of the biggest difference. So to answer the second question, yes, they could benefit, but it's really, really important to be careful. And especially if you're wanting to have them receive and be eligible for some of those government benefits, or traditional trust structure probably isn't the best option for someone with special needs.
And just to add on to that, if let's say today you do have a child with special needs, and they would be they're not utilizing government supports, if there's a possibility down the road that they might need that, maybe because of the care you're providing or just the progression of whatever it is that they're dealing with, that special needs trust would be helpful. So it's important as you're looking at your special needs child to, yes, see them as they are today, but also recognize any of the changes that might take place down the road and factoring that in. So just a couple of things to consider there.
That's a good point.
Great questions. Thanks, everyone.
Thank you, everyone. Thank you for the great presentation. And we really appreciate you joining us. Again, look forward to have you join us for future presentations, and keep an eye on your inbox for follow-up materials from this presentation. We hope you all have a great rest of your day. Thank you.
Thank you.
See you.